Hello again and welcome. It's Mark Masterson, Managing Director and Partner at Hightower, Naples, and this is our quarterly video market commentary for October of 2018. Thank you again for joining me, and I have to tell you I have a lot to share with you today, so let's jump right in. We'll begin again with the Four Horsemen, and I want to point out to you that the Four Horsemen have changed just slightly. And the changes reflect what's going on under the hood today within the economy and the market. So let's start over here with the fundamentals. As you can see, we're still bullish. We're bullish because the economy and earnings are doing great. Fundamentals are solid. Second quarter GDP was confirmed at 4.2%. Hadn't seen that in a long time. Quarterly earnings are coming off of records, and expectations for the third quarter are off the charts. Employment still near peak levels. Business confidence is near peak levels. We're going to talk about all of that. So really booming. Things are looking very, very strong at the moment. But I have to tell you, I came very close to changing that bullish to neutral. Why? Because the risks are now more balanced today. When we started this coverage under Trump, we felt that we were going to be moving from a bad to less bad economy. And that's taken place. But now earnings, the comps, year-over-year comps, and GDP year-over-year, it's going to be harder to beat. So we're now in more of a show-me environment. So the risks have changed. The rate of change maybe in terms of growth may be changing. We got to keep an eye on that. But we're still bullish. In terms of the technical analysis, the charts, the patterns, and the trends, still bullish there too. The channel remains intact. The markets all broke out of their trading ranges to the upside. 50 and moving 200-day moving averages we're still trading above those. So while in the very short term we expect a pullback, and we'll talk about that, overall still bullish regarding technical. In terms of sentiment, we're neutral. We're neutral. This could have easily been bearish as well in the very short term, just because sentiment's getting a little bit overheated. Smart money is a little heavy on the short side today. They expect some weakness. Investor sentiment at the retail level is a bit elevated as we enter the fourth quarter. Funds are positioned with very little cash. So we are seeing a little bit of an overheated sentiment picture, and that tends to be a contrarian view, and we'll have to keep an eye on that. And lastly, policy. Fiscal and monetary. We're neutral there. Why are we neutral? Well, it's a mixed picture. Monetary policy, we know the Fed is being very clear in terms of their direction. We know they're hiking rates. There is a risk that the Fed tightens too much. They go a little too far. Other central banks do remain accommodative. That's a good thing. On the other hand, fiscal policy. It's been extremely good for the economy, for earnings, for the markets. Tax cuts. We have the deregulation. All of that's a positive. And then, of course, the negative is tariffs. It is a headwind. We're seeing some resolution there with the new NAFTA, but China remains an issue. So that's why we're neutral. Overall, it's been a very, very good year in terms of policy and its impact over here on fundamentals. But at the moment, we do have some risks, and we're going to talk about those in a brief moment. So let's take a look at the fundamentals. Economic growth has been great. As you're well aware, most likely, year-over-year change is almost 3%. Last quarter was 4.2%. More importantly, the trend has been up. You can see each quarter we've been moving higher. Cannot complain about that at all. A great bit of that growth that we're seeing in GDP can be, attributed right here. When you look at fiscal policy, we've got a tremendous amount of boost that's being pumped into the economy from the tax cuts, the spending, deregulation, and repatriation. And I think this is a great chart because it also shows just how much this dwarfs the impact of tariffs, or the estimated impact of tariffs. So while this is a headwind, we are seeing the growth being really being pushed higher and higher by these positives. A quick note on tariffs. This chart from Strategist does a great job of showing some of the imbalances between exports and imports. And as you can see, this is the major imbalance really lies with China. You can see it, Canada, Japan, Germany, Mexico. Yes, there's a trade imbalance, but this is why the Trump administration is really focused on trying to fix this imbalance. It also happens to be this gap between exports and imports happens to be our leverage moving forward. Moving on to earnings and profits. Can't say enough about this huge ramp that we've seen in earnings, really driven by the fiscal stimulus. Same thing here with profit margins, really have turned up, and they've just been fantastic. I do want to point out in this red box, these greenish bars are expectations. So the real challenge, again, coming back to that show me type of fundamentals, can we continue the path, or will we see a bit of a rollover? That's an unknown. We'll have to keep an eye on that, but this has been tremendous. Another positive chart, just showing the trend in operating margin year over year. We continue to see companies' operating margins on the rise. Why that's important is because these gray bars represent recessions, and as you see, before we hit a recession, you'll always see that turn down. And certainly right now the trend is still up. We're not seeing any sign of turning down. Another positive chart here showing CapEx on the rise. We're seeing companies spending more money on themselves. And I will point out that we had a long period, multi-year of decline there. We're just now turning up. And if you look back, going all the way back to the 90s, these trends, once they turn up, they tend to run for a while. So we may be in the midst here of a CapEx boom that could last for some time. And that CapEx boom is partly being driven by cash coming back. So here's a chart that shows the repatriation that's underway. A huge boost in the first quarter. Second quarter was, again, not quite as much, but still a fairly large amount. We think there's more to come. And again, this is driven by the tax cuts at the corporate level. A big positive for the economy. The consumer is certainly noticing. We can see here in these two charts that consumer confidence is nearing highs. This is quite good for now. It's also a risk. At some point you reach a point where the consumer confidence rolls over, but that won't happen typically until you reach a recession. And as I pointed out, and as I'll show you later, we're not quite there. We could have some time before that happens. So the consumer's feeling quite good about what's going on. I like this chart because this is a chart showing leading economic indicators. That's an index that incorporates a number of things, employment, housing, interest rates, etc. And what's important to note is that it is heading higher. We haven't rolled over. We're not turning down. And that's relevant because if you look at these gray bars, these are recessionary periods. And the one thing you'll notice before each of these gray bars is that the leading economic indicator index went negative. So we have to cross this line each and every time before we hit a recession, and we're still moving higher. So that would indicate to me that we have some time before the economy would start to show any signs of recessionary or really turning down. So that was a lot of positive charts. So let's take a look quickly at a few things that may be potential risks moving forward. This is a great chart from Hedgeye. Hedgeye is a solid macro shop that we follow and get their daily news email. And they put this chart together and they ask, is this as good as it gets? And what this chart kind of shows you here is going all the way back to 1949 down here. We've been on a great streak, of 9 consecutive quarters of rising growth. And that's kind of rare. So again, that begs the question and shows us that we are in somewhat of a show me environment where the economy must continue to grow, the rate of change must continue to turn up, or we may see a pause in the markets. Another risk is the possibility that the U.S. is really the only game in town. So as this chart shows you, here in the U.S. we're seeing growth accelerating and rising, whereas when you look at the rest of the developed economies ex the U.S., they're actually in a decline. So the question is, are we going to see this stalling of growth internationally? Is it going to come washing back up on our shores here at some point? So the risk that we mentioned earlier about this being a show me environment, we are starting to see negative earnings pre-announcements on the rise. So here coming into this third quarter, into the third quarter earnings season, As of right now, we're seeing a large number of earnings pre-announcements that are kind of dialing it down a little bit. And you can kind of see that on this chart here where we're starting to see a rise in negative earnings pre-announcements. That needs to be watched because, you know, the S&P 500 earnings are expected to accelerate from 25%, which is phenomenal, to 36%. That's pretty big expectations. And technology, it's even higher, looking from 35% to, in the second quarter, year over year, to up 41%. So high expectations. Will they be met? We'll have to see. That's the challenge. More than likely, we'll start to see a little pause here or maybe even a rise, and that could be some headwinds down the road. I mentioned back on the Four Horsemen slide that monetary policy and accommodative monetary policy could be a risk. The Fed could tighten too much. Other central banks could reduce liquidity. This chart is great because it shows all central banks, the major central banks. And what you see here, more importantly, here's the Fed. And what you see is the Fed ending QE. They're not expanding their balance sheet. And now we're turning down. So the Fed, as you know, is trying to shrink its balance sheet. In fact, it's going to reduce its balance sheet by $50 billion a month starting next month, which is 5 times more than last year. So this line may accelerate lower. We are also hearing that the ECB plans on ending its QE program in December. So what we may see here with these central banks, which is a reduction in global liquidity as we go into next year. And that could be a risk because global liquidity and monetary policy that's been accommodative has been clearly a boost to risk assets. And the question is, if that reverses, will risk assets follow and reverse as well? And lastly, we need to watch the yield curve. We've discussed this in the past, but when short-term rates, the 2-year Treasury rate, is higher than longer-term rates, the 10-year Treasury, you get an inverted yield curve. And as you can see, we're not quite there, so it's not a risk yet. But in the past, when that yield curve inverted, we saw stock markets pause and peak, and eventually recessions as well. So that needs to be watched. Having said that, it is not perfect as a timing tool for sure. So this shows some of those periods where the yield curve inverts, 78, 80, 89. Yes, a couple of times these 3 brown arrows, the stock market peaked within 2 months of that yield curve inversion. Other times it took 18 and 20 months for the market to peak. Likewise, 100% of the time we went into recession after the yield curve inverted. The problem is it was 11, 17, 19, 14, 23, many, many months, sometimes almost 2 years before the recession arrived. So it is valuable, but is not predictive. So what does all of that mean to investments? Let's start with the stock market. This is the 30,000-foot view of the S&P 500, and as I mentioned in the Four Horsemen, the technical picture still looks great. This is the bull market. You can see it's still riding up in the channel. A couple times we tested here the lower end of the channel. Here we hit the top. We moved all the way over, test again, and now we're moving higher inside that channel. So still strongly bullish from a technical picture, longer term. And here's an updated chart that I put together during the choppy months, February, March, and April for clients. I wanted to show that bull markets don't just go in a straight line. In fact, since 2009, you'll see this bull market that we're in has had multiple periods where we had an easier rise, then it got choppy, then another easier rise, choppy, easier rise, a bit choppy, sideways consolidation. This was a big one in 15 and 16. In fact, this could have been considered a bear market easily, and this a new bull market. But here we go into an easier period. And in 2018, you can see we spiked up. We got into some choppy markets, harder. But take a notice, please, that we are now moving out of that and perhaps entering an easier market environment, which would be consistent with our longer-term theme here that you do not want to miss the final innings or the final few years of a bull market. You may remember this chart, but these are the previous peaks of bull markets, so this is when they ended. And this is the 2 years and the 12 months before they ended. And you can see the returns are typically very, very strong in the final couple years of a bull market, if in fact we are in the final couple years. I think it's important to point out that 2018 has not been easy for all stocks. In fact, we have seen truly America first. U.S. has ruled the roost. You can see that in a couple of these charts where, Here you have the S&P 500 moving higher with the international EFI and the emerging markets moving lower. You see it visually here again. Big divergence going on with the U.S. drastically outperforming. I'll point out in this chart where you see the black is the S&P 500 and the red is the MSCI World Index. It's not uncommon that they move together, but there have been periods when we saw big outperformance. In fact, right now you're seeing in the green box where the U.S., the S&P is outperforming the MSCI World. But back here in the early 2000s, you can see just how much the MSCI World outperformed the S&P 500. This was a multi-year period where that took place, and we saw it again here coming out of the lows of the bear market, 2009. So perhaps we're now just starting to see the beginning of a multi-year period where the U.S. will outperform. This is a quick visual that I showed clients a couple weeks ago. It's not totally up to date. It's actually about 3 weeks old, but the data hasn't changed too much. And really it's just a visual to show you just how much the U.S. has been kind of the lone man in town. When you look at all these other major developed and emerging market ETFs and you look at some of the returns this year, it's been pretty ugly. There's a lot of red internationally, and the U.S. is one of the few that's showing strong results. So here we are. We find ourselves in this midterm election year, and as our expectation was that when you come into a midterm election year, you tend to see volatility. So this chart shows that there are corrections during midterm election years every single time. Well, we had one this year in February, March, and April. More importantly, we expected to have August and September lower ahead of the fourth quarter that tends to be strong in a midterm election year. In fact, that did not happen. August and September were both positive. Not only were August and September positive, we had a great third quarter. And historically, that's been a very good sign for the next 1 to 3 quarters. So you can see in 2018, the third quarter was up 7%. So we really regained a lot of ground. And if you look at this historically going back to 1950, the next quarter after a strong quarter tends to be positive, and it tends to be pretty good. There was one negative quarter, and that was back in the 70s. And then the next quarter beyond that as well tends to be a very positive string. There were a couple of negatives there. So all in all, that's a very good sign that we had a strong third quarter. It bodes very well for the next few quarters. And I'm going to tell you the next few slides are going to be some really good news. This slide highlights that historically after midterm elections, the next 12 months for the S&P 500 dating all the way back to 1950 have all been positive. Different degrees of positive, but they've all been positive. Pretty good news. And if you take a look at the S&P 500 monthly returns during midterm election years, what this chart shows you is that since 1950, no month has been stronger for the market than October in a midterm election year. And if you wanted to rank them in terms of months, October's number 1, November's number 2, and December's typically number 3. So we're in a pretty good window right now for the market historically. We are getting a lot of questions about what might take place depending on how the midterms actually play out. And there's some concerns that we could have some high turnover, et cetera. But I want to point out a couple things. First of all, and perhaps most importantly, did you know that the most bullish scenario under a Republican president, in fact, under a Democrat president as well, is a split Congress? This shows that since 1950, the average annual performance going back to 1950 through 2017, it shows under a Democratic and a Republican president, the market's returns always best when it's split, when we have gridlock. So perhaps that's why once the midterms are over, once we get into that window, the markets tend to not look back. So not only are we in the best window seasonally for the markets, also within a midterm election year, but also within the presidential cycle. So within a president's 4-year term, year 3 is always the best. You can see that represented here in terms of the next 3 quarters that we're looking at, and then the same type of thing down here where it shows the average returns for the market during a president's 4 years, and year 3 tends to be the best, and we're just now starting on that time frame. One concern that clients raise is valuations, and rightly so. We are definitely not cheap anymore, but I'm just going to share this chart with you. If you really want to look at the numbers, you'll have to pause it and just stare at it. But what this chart from Strategis shows us, over here we have a number of different valuation metrics for the market. Here's our current level where the S&P is today, and here's the 20-year average. And what you're going to find when you look at these is we're not extreme on most of these metrics at the current level, and you can pause and look at that yourself. This follow the money chart just gives us a look into buybacks, corporate buybacks. We know that's kind of a tailwind as companies are buying back their own shares, and you can see we have buybacks on the rise. So that's another tailwind for the markets. And another one of my favorite charts, never gets old to me when I look at following the money. Where are people investing their capital? And this chart is updated through the beginning of September, so the numbers may be a little different, but boy, year to date, you can see there's just no love. Still having outflows for U.S. stocks. I already pointed out and showed you that U.S. stocks are really the only game in town this year, and yet investors are plowing their money into international stocks, taxable bonds, everything but U.S. stocks. So all I want to point out on this chart is this is not, and if you go back and look at the inflows into U.S. stocks going all the way back to when this bull market purportedly began, this does not have the DNA or the fingerprints of a bubble from my perspective. This has got to be the most unloved bull market of all time. What would a market commentary be without a little bit of other side of the coin? I mentioned in the Four Horsemen that sentiment was a little heated. This is a couple of examples I'll show you here. This blue line shows the smart money, quote unquote, from sentimenttrader.com. And essentially what you're looking at there is the fact that major hedgers are short the market quite a bit. So they're expecting a bit of a dip, of a pullback based on their positioning. And that usually does happen before a pullback takes place. So we may see a short-term period of digestion here in terms of the fact that they're positioned a little more bearishly. And this chart shows, the weekly advisory service sentiment, and you can see this green line, that bullish sentiment's back up over 60%. That's pretty high. It's not the all-time high. We saw that back here in February. But again, what happened after February was the market retreated, and we're getting up here to a point where we typically would see the market pause and pull back a little bit. So sentiment is definitely a little bit overheated. I could point out a few more things that are short-term risks, but like market internals, etc. But let's go ahead and move on in the interest of time. Take a quick look, very brief look at bonds. Our view hasn't changed. We expect that we are bottoming. Interest rates came down for years, decades in fact. We're now in the bottoming process. I drew a little red line here that shows that this is a process. Here's where we are now. Rates are on the rise, but we expect them to kind of chop around for a year or two before they start to move up in earnest. And again, rising rates shouldn't necessarily be feared. In fact, if you look at this chart, it shows that if you look at these periods in the past of when rates were on the rise, equity markets have performed pretty well. Going all the way back to the 60s, there were 17 different periods of rising rates, and only 3 of them saw the market pull back. And we're not talking about by big amounts over that period. In fact, most of the time the market responded pretty favorably to that. So keep that in mind, that rising rates don't necessarily have to be feared. Our expectations haven't changed on bonds, so we'll move on. We're somewhat underweight anyway for clients there. Let's take a quick look at currencies and real assets. We are watching the all-important U.S. dollar, and again, we find it at an inflection point. This is a 20-year view. Back here, we saw a triple top before a big decline in the dollar. Our view has been that this, too, was a triple top. We started a pretty good decline for the dollar, but we've been rallying ever since, and we're at an inflection point. We saw it hit the underside of that blue line that I drew there as resistance, and the question is that a kiss goodbye? If it's a kiss goodbye, which often happens, once it breaks down, it rallies back to the underside and then it heads back down lower. If that's the case, then I think that'll be very good for U.S. stocks, commodities, gold, things of that nature. If the dollar were to continue to rally, however, and break out again to new highs, well, then that's going to be a more challenging environment, I believe, for all of us in terms of capital markets, and we'll have to keep an eye on that. So an important point for the dollar. The dollar definitely impacts commodities, and this chart shows the quilt of asset class returns, and commodities have been in the doldrums now for years. In fact, it's so rare to see any asset class just stay in the bottom of performers. We're yet again there this year and year to date, and it's my opinion at some point here as the dollar breaks down, most likely that you start to see commodities start to outperform. This chart of the Bloomberg Commodity Index shows just where they've been. This was the low back in 2016. We saw a nice rally, and since then we've just been chopping inside a trading range, this being the bottom and this being the top. So we need to see this break out for anything meaningful to take place. But historically, we are at a point where we would tend to see that take place with commodities. So this chart shows the ratio, the relationship between commodities and the S&P 500. When this is rising, this green line is rising, then the S&P is outperforming commodities. When it's falling, I'm sorry, the other way around. When this is rising, commodities are outperforming the S&P. When this is falling, the S&P is outperforming commodities. So we've been in this downtrend where the stocks have been outperforming commodities. But you can see we are now bottoming, and just like in the past, we're at a level that's pretty extreme. And normally you would expect this to turn up and you start to see commodities outperform stocks. That does not mean stocks don't perform well. It just means commodities perform better. Gold is one of the commodities that we hold typically for a hedge for many clients. You can see this weekly chart of gold shows it got deeply oversold. The most it's been oversold in 5 years, seems to be basing here, and to us it looks like it's likely to begin a rally. And the fuel for that rally will likely be the short interest. This chart shows the massive spike in short interest by the speculators. So there's been a huge bet on the short side for gold that it's going to continue to go down way out of the range of normal. In fact, back here, this spike here was the bottom after the bear market for gold that ended in 2015. And when that bottomed, gold rallied 30% from the lows, and now we're nearly double that. So tremendous opportunity for gold to rally if these shorts have to cover and this spike has to head back down the other way. You could see a very large rally in gold. What the catalyst is going to be, we don't know yet, so we have to keep an eye on it. But that's the fuel for the rally. So we've covered a lot of ground, and I hope this review was helpful to you. And as you see, we remain constructive and optimistic on equities. We're fairly neutral on fixed income. We expect commodities to rebound soon, depending on what happens with the US dollar. And we're certainly optimistic on the fundamentals, but we are watching closely to see if the high expectations can be met in the coming quarters. So again, I want to thank you. I want to thank you for joining me. Again, as always, you can follow me on the daily on the morning roundup if you want to subscribe to that, and we'll send you our thoughts on capital markets every day. And of course, you can reach us with any questions, any comments, any concerns anytime. Have a great day.